Welcome to this deep dive into the 200 EMA, one of the most respected and widely used moving averages in all of trading. The 200 EMA isn't just another line on the chart. It's a dynamic tool that tells you a lot about the market's long-term trend and momentum. Institutions, hedge funds, and professional traders all monitor the 200 EMA because it often acts as a line between bullish and bearish market sentiment. Let's break it down from the ground up. What is the 200 EMA? The 200 EMA is the exponential moving average of the past 200 candles on your chart. Unlike the simple moving average, SMA, which gives equal weight to all candles, the EMA gives more weight to recent price action. That makes it more responsive and a better reflection of current market conditions. On higher time frames like the daily or 4-hour, the 200 EMA reflects the long-term trend. On lower time frames like the 15-minute or 5-minute, it acts more like dynamic support or resistance. 200 EMA as a trend filter. One of the most basic uses, trend confirmation. If price is above the 200 EMA, you're in a bullish environment. You should be looking for buying opportunities. If price is below the 200 EMA, you're in a bearish environment. Look for selling setups. This is especially useful if you want to filter your trades and avoid going against the broader trend. 200 EMA as dynamic support and resistance. Unlike horizontal support and resistance levels, the 200 EMA is a moving, flowing line that changes with price over time. In an uptrend, the 200 EMA acts as dynamic support. When price pulls back into the EMA and bounces, that confirms buyers are stepping back in. In a downtrend, the 200 EMA acts as dynamic resistance. Price touches the EMA and sells off again. That's institutional sellers defending the trend. These reactions make the 200 EMA a powerful level to watch for entries or exits. Confluence with price action. Here's where it gets more advanced. If price is at a strong horizontal support level and the 200 EMA is also lining up at that area, that's confluence. That significantly increases the probability of a bounce or a reaction. Similarly, if you spot a bullish order block, a high or low, and the 200 EMA all coming together, you've got a potential high probability setup backed by structure and dynamic trend confirmation. Golden cross and death cross. When the 50 EMA crosses above the 200 EMA, it's called a golden cross. This is a major bullish signal, often followed by strong upward momentum. When the 50 EMA crosses below the 200 EMA, it's a death cross, a major bearish sign, often seen before strong sell-offs or bear markets. These crosses don't happen often, but they are watched closely by large investors and algorithms. Scalping and intraday use, even scalpers use the 200 EMA, especially on 1-minute to 15-minute charts. It serves as a quick trend filter. Only buy above, sell below, a reaction level. Price taps the 200 EMA and either rejects or breaks through. That's your clue for short-term direction. In this case, the EMA isn't about long-term trends. It's a dynamic structure level to watch for reaction. EMA as a reversion zone. Sometimes, when price moves far away from the 200 EMA, it creates what's called an overextended market. Price tends to revert back to the 200 EMA, either through a pullback or a period of consolidation. So, if you see price stretched far above or below the 200 EMA, don't be surprised to see it snap back. This can help you avoid entering when the move is already overextended, or even take advantage of mean reversion trades. For best results, combine the 200 EMA with price action, structure, order blocks, market structure shifts, support and resistance, horizontal key levels aligning with the 200 EMA, volume. Increasing volume as price approaches the 200 EMA confirms strong interest. RSI or MACD. Momentum indicators that confirm strength of reaction around the EMA. A 200 EMA on the 1-hour chart might tell you about the short-term trend, but a 200 EMA on the daily chart is watched by institutional traders and funds. So before making any decision, ask yourself, what time frame am I trading? And what time frame is the 200 EMA giving me context from? At last, the 200 EMA is not magic. It's not always going to hold, and it shouldn't be used blindly. But when you understand the psychology behind it, how many traders respect it, how it reflects long-term market consensus, it becomes a powerful tool. That wraps up this deep session on the 200 EMA. More than just a moving average, it's a dynamic tool for trend identification, support and resistance, and high probability setups. Whether you're a day trader, swing trader, or just starting out, understanding how the 200 EMA works across different time frames will keep you aligned with the bigger picture, and that alone can separate winning trades from losing ones. As always, don't just watch the line. Watch how price respects the line. That's where the real edge lies. Thanks for tuning in. Stay smart, trade with clarity, and I'll see you in the next session.